The lady isn't tapering. With these words, Christine Lagarde announced that the European Central Bank won't lower the financial support for the Eurozone anytime soon. The move was not unexpected, but it was still very significant. What's up everyone, my name is Joris, welcome back to my finance channel. During the meeting of the European Central Bank on Thursday, Christine Lagarde proposed the adjusted plan of the European Central Bank and their money policy for the rest of this year and the starting of the next one. A small reminder, at the present, the European Central Bank supports our economy in several different ways. The first one is the interest rates of the main refinancing operations and the interest rates on the marginal lending facility and the deposit facility. Those rates are respectively set on 0%, 0.25% and minus 0.5%. Secondly, the Asset Purchase Program or APP. With this program, the ECB supports the economy with a monthly purchase of bonds worth 20 billion euros per month. There are no indications to end this particular plan. The main purpose of this plan is to boost the financial inflation of the desired 2% on a yearly basis, something the ECB has been trying for years and has failed at consistently. Once the inflation is under control and steadily fixed around the ECB's target of 2%, they will also try to raise the interest rates and most likely stop the APP, or at least limit it. But for now, the Governing Council also intends to continue reinvesting in full the principal payments from maturing securities purchased under the APP for an extended period of time past the date when it starts raising their key ECB interest rates. And in any case, for as long as necessary to maintain favorable liquidity conditions and an ample degree of monetary accommodation. The third support pillar is the Pandemic Emergency Purchase Program, or PEPP. This program was put into place to support the European economy during this unforeseen pandemic. A total envelope of 1,850 billion euros was put into play to be invested in the economy up until March 2022, or up until the point the committee judges the crisis phase to be over. The fourth and final support pillar of the ECB are the refinancing operations. The Governing Council will continue to provide ample liquidity through its refinancing operations. The current TLTRO3 plan, the third version of the targeted longer-term refinancing operations, is currently into play. It provides cheap and long-running loans to European banks in order to transfer that money to the people. If banks get cheaper loans, they in turn will give out cheaper loans to their clients. This way, more money gets poured into the economy, more liquidity is achieved, and more inflation is created. The European Central Bank policies, their support policies, are now revised and some of them are adjusted. First off, the interest rates. Those rates of 0%, of 0.25% or negative 0.5% for the main financing operations, marginal lending facility and the deposit facility have not changed. As long as inflation stays under the desired 2% yearly target, there is no incentive to raise those rates. The key point here is the average inflation. Even if the inflation rises over 2%, like it is doing right now in 2021, the European Central Bank won't change their policy just yet. They expect the inflation levels of today to be of a temporary nature. And they won't hold long in the future, they won't hold in the next few years. The European Central Bank expects inflation levels of 2.2% over 2021. But in 2022 and after, they expect inflation levels to drop under the 2% again. So there is no rush in raising those interest rates, which will support real assets such as the stock market and the real estate. As a direct consequence, the Asset Purchase Program, the APP, won't cease until the interest rates rise, and will most likely continue even after that raise to ensure ample liquidity conditions in the markets. The PEP program does have had some changes to it. The Governing Council judges that the favorable financing conditions can be maintained with a moderately lower pace of net asset purchase under the PEP than in the previous 2 quarters. As of today, the European Central Bank is buying 80 billion euros worth of bonds every month. But by the end of this year, this monthly amount will lower to 60 to 70 billion euros worth every month. The central bank will continue to reinvest the principal payments from maturing securities purchased under the PEP at least until the end of 2023. And the final support pillar of the TLTRO3 plan won't change anytime soon either. It provides ample liquidity in the market and it makes sure that the people get access to the cheap money. As long as the inflation stays too low, these support plans won't change. Since the European Central Bank doesn't consider these changes to be tapering, but a mere recalibration of the stimulus efforts, there is no real difference in financial support by the end of this year. The European Central Bank has taken its first meaningful step towards tapering today, said Seema Shah, chief strategist at Principal Global Investors. Characteristically, it hasn't tied itself to a specific pace of purchase, instead retaining an element of flexibility which will be helpful in the face of a potential tightening in the financial conditions as Fed taper draws near. Personally, I don't expect the European Central Bank to make any major changes before the Fed does in America. The European Central Bank always looks across the pond to decide what is best. And that's understandable. We don't want to stay behind on an economic growth scale if the USA keeps supporting their economy and we are tightening policy. The European Central Bank has to be aware of four main dangers. They have to beware not to freeze the economic growth in the Eurozone by tightening the policy. Even though we are doing great and growth is coming back, we are not at a point yet where we can let go of our financial support. Apart from that, the European Central Bank has to stay vigilant that the inflation doesn't go overboard. Current rising asset prices are affecting purchasing power and jeopardize companies' operation margin. A third danger is the rise in interest rates. In a way, a rise in interest rates is one of the main goals of the European Central Bank, but they have to keep a close watch on those rates. Interest rates that rise too fast or too high, they will have an extreme consequence for the outstanding debt of the European countries, many of which have huge debts added to their deficit due to the pandemic. And lastly, the long-term low interest rates in combination with a high inflation will result in the loss of purchasing power for the common people. If interest rates are low, there is next to no return on their savings accounts at the banks. And if prices go up, on the other hand, which is the cause of higher inflation, life will be more expensive for them. It will lead to a bigger gap between rich and poor. While low interest rates are a blessing for investors, it is a death sentence for savers. Low interest rates and high inflation for a longer period of time will cause a financial disruption. It will cause the financial system to destabilize. The financial supports are great for the economy, but I don't think it is possible to keep this way of investing, this way of financing possible for the long term. The financial balance of the European Central Bank has been growing exponentially over the last few decades, and at this rate it won't be manageable in the future. At a certain point they will have to lower their balance aggressively, which might have a major consequence on the economy. But for now that's a problem for tomorrow, but a problem nonetheless. Apart from that, all the national debts of the European countries have grown exponentially over the last decades. Debt that is manageable as long as interest rates stay low, but it will become problematic if interest rates go up. This will have to be monitored very closely. Don't forget to like the video for the YouTube algorithm, and don't forget to subscribe if you're not subscribed already. I thank you very much for your support, I thank you for watching, and I will see you in the next video.